once ETH kind of gets through if it can get through 5K and start to push towards 6K or so, then I think we could see the big move that everyone's looking for with meme coins and kind of that longer end of the risk curve. So that would be the ideal setup. That's sort of my base case of what should happen. That would be like in line with how things typically go.
GM, good morning. Welcome to the Milk Road Show, the daily crypto show where Jerome Powell basically said, shots on me, and the whole market lined up. I'm your host, Jay Hamilton. It's Thursday, September the 18th. The Fed cut rates by 25 bips in the first rate cut of 2025, and we could see up to 50 bips in additional rate cuts for the rest of the year. Today, we'll break this down along with the rest of the US economy and the macro setup, why we think it looks so good as we head into Q4. We'll also dive into the outlook for the crypto sector specifically. We're going to look at Bitcoin, Altseason, and some spicy charts and predictions at where this cycle could end and how things could play out from here. Today, we are joined once again by one of our favorite guests, Michael Nadau, investor, writer, educator, and founder of the DeFi Report. Before we jump in, I've been telling you guys this all week. If you are swapping, you should be checking out Milk Road Swap. Not because it's our product. We built Milk Road Swap because we wanted a place to do our own personal swaps that was low fee. That's why we built this. So check it out if you're doing swaps at swap.milkroad.com. Today's episode is brought to you by Figure Markets. Grow your cash like a bank. No lockups, just real returns. It's also brought to you by KGeN, the verified distribution protocol, changing the growth game. With that, Michael, welcome back to the Milk Road Show.
Great to be here, Jay.
Pleasure to have you as always. Okay, let's start with the news of the day, which is Jerome Powell and the Fed and what came out of them. I'm just going to pull up a summary here from the Kobayashi letter. Okay, so Fed cut rates by 25 bips. Median projection shows 50 bips in additional rate cuts for the rest of the year. Governor Moran dissents in favor of wanted a 50 bip rate cut today. Always interesting when we see those very vocal dissents. The Fed says downside risk to employment has risen. So there's a clear shift that they're really trying to focus on the labor market. 6 Fed officials see no more rate cuts in 2025, and 9 see 2 additional rate cuts in 2025. So a real discrepancy there. Michael, what's your thoughts on this news?
Yeah, big day today. This is kind of like the current catalyst for the markets. And, my view on this was the 25 basis point cut that we just got today was priced into the markets. It was like almost at 100% certainty going into this. And so we'll see how the market reacts to that. I think the last time the meeting just ended, and I think markets were down a little bit. So markets are going to digest this, and we'll see where things go. But a lot of the work that we've been doing is really to get a good sense of like the state of the economy, because I think the key thing here is like if we're going into a rate cutting cycle, and it looks like we have at least 2 more cuts getting priced in before year end. The key question that I'm asking is, are these rate cuts sort of more of the insurance cut type variety, which I view as bullish for risk assets, or is this sort of telling us that there's something more going on in the economy? The economy's weaker than we think. It's a sort of sell the news type of event. So I think we can kind of get into some of that macro data here, and then sort of transition into what that kind of could mean for the crypto markets later in the show here.
Yeah, okay, let me pull up some macro data you shared. As always, some great charts with us before the show, which we greatly appreciate. Okay, let's go through some of these charts in the macro data.
Yeah, I'm sure everyone's familiar with the Bitcoin and global liquidity chart from Cross-Border Capital here. I think the takeaway on this one is liquidity continues to expand. That is obviously a good thing for risk assets, a good thing for Bitcoin. We can tell that Bitcoin is quite correlated to that global liquidity line here, which is the orange line. I think the way I think of this is as long as liquidity is expanding, there is no like smoke alarms, going on out there. Liquidity should continue to expand with the Fed now cutting rates that could, lead to some more bank lending and just sort of potentially more hiring, more activity in the economy. So I think this picture looks pretty good. I would say that just one thing people should keep in mind here is you'll notice that if you look at that second top of the last cycle, the black line there, that second top, it just, yep, exactly. We can see that the orange line actually kept rising past the cycle peak. So there wasn't necessarily a warning signal to investors to sort of get out of the market at that time. You could have looked at the global liquidity chart at the pico top of last cycle and said, we're good, we're going to keep going up. And that wasn't the case. So people should just be aware that liquidity can still expand. And then there's sort of a lag to that with the change on the margin, and then what can happen with the price of Bitcoin and other risk assets. So just keep that in mind. But for right now, liquidity conditions look strong to me.
Okay. What about the U.S. economy? Let's look at some stuff around the U.S. economy and the strength, because I think that kind of gets back to your original question of like, are these rate cuts bullish or bearish is always a difficult perspective. I mean, I feel like trying to listen to Jerome Powell feels like trying to read a puzzle, like as it's being laid out in front of you. So let's look at some charts here. What are you seeing here?
Yeah, so this is just the retail sales data that we got yesterday, and this is important to me just because 70% of the economy is consumption, 70% of GDP is consumption, and so we just got this data yesterday. Retail sales are still coming in strong, 6% growth over last year. If there was like significant trouble in the economy and things were rolling over, we would expect to see retail sales sort of trailing off. That's not the case. So this is a bullish indicator to me that there's some strength, in the economy. People are still spending out there,
especially as we go into Q4, which is traditionally the biggest retail sale quarter of the season. So we have seasonality as well. It feels very strong. Okay. Labor markets. What are we seeing on the labor side? Because this is the side that's harder to read right now.
This is what is causing the Fed to cut rates. The Fed has been concerned about, sort of stickier than normal inflation. But at the same time, we've had weakening in the labor market. We had 900,000 jobs that were revised out. And what this chart is showing is a divergence between retail sales, which is the lighter blue color that's going up, and the private payrolls, which is the darker blue color, going down. And so, this can't go on for this. This disconnect cannot continue. And so either you're going to see payrolls rise to meet, sales to show that the economy is stronger than we think, or the retail sales are going to drop to meet the private payrolls. We can see that like this also happened like about a year ago. And it was actually a very similar time period just before the Fed cut rates. They did 50 basis points last September. But you had a similar dynamic where those two lines were diverging. They later ended up meeting, where you can see the blue line kind of came down and then it moved up to meet the sales. And so, I'm just looking at this. My base case is that blue line that's going down is going to actually rise up, because I view these cuts as more of the insurance variety. And so, the labor market, my view on this is like, it's basically at equilibrium right now. So, and that's why the unemployment rate hasn't really, spiked up. It's at like 4.3%. What's interesting is like that equilibrium point is happening at like a lower sort of job growth rate. So there's less demand for jobs, partly I think because a lot of foreign workers are leaving the country under the new immigration policies, and so you have less demand in the labor market, and the supply is actually shrinking as well. So you're at equilibrium, and the Fed now has to step in and sort of prioritize this a little bit more. And I think that's why we're seeing the rate cuts. My view on this is if CEOs out there are confident that the Fed is going to continue to cut and lower interest rates, that should give confidence to CEOs, hiring managers, to be able to go out there and kind of start to plan for the future a little bit more, hire people, invest in growth, and we should see the labor market recover here. That's kind of my base case of kind of what these rate cuts, the impact that they're going to have on the labor market.
To continue on that, let's take a look at the labor supply and demand, because this perfectly is the next chart here.
Yeah, this just shows that, we're at equilibrium. So, what can happen with the labor market when you start to see softness is if we did start to see more layoffs coming, it tends to accelerate very, very fast. And I think there's reasons for this. Part of it is just almost, I don't want to call it copycat behavior, but if, let's say, you're a business and you're sort of struggling, maybe you're starting to think that you need to do layoffs, but you don't want to do that because it makes you look weak in the market if you have to announce layoffs. You try to hold on till the very last point that you can hold on. And if you start to see your competitors, other parts of the economy, other industries starting to do layoffs, it kind of gives you like the permission to do them yourself. And so that's part of why there's some reflexivity to the unemployment rate when it does start to get, when the labor market gets weak. That is what the Fed is trying to prevent from happening by cutting rates. But I think the key takeaway is that we're at equilibrium, so we don't have this like issue where there's not enough job. If you're looking for a job, there's as many jobs out there available as there is demand for them right now. And we're just keeping an eye on this to make sure it sort of stays in equilibrium, and hopefully more job openings come and you start to get a gap there between the supply and demand for labor. So.
Okay, so labor market looking strong, and obviously these rate cuts are only going to assist the labor market and assist the business cycle, which we haven't seen the business cycle really enter into its typical form as we all have been kind of expecting it to for a while now. So these rate cuts should help with that as well. Let's just keep rolling through your charts here because I want to make sure we get through them all. And there's lots of stories to tell here. What do we got up next here?
Yes.
The U.S. high yield index. Okay, yeah, go ahead.
This is just a credit spread, and a good point. Maybe just to add on to what you just said about the business cycle there. Like the ISM, which is one, I think, great way to measure the confidence in the business cycle, has still been in a contraction zone. The manufacturing ISM in particular. That is like 10 to 12% of the economy. So a lot of people are paying attention to that. It does tend to be a really strong indicator when you see that move into expansion and get above the 50 zone. It tends to be good for the economy and for risk assets. Potentially going to see that break out with these rate cuts as well. Coming back to the credit spreads chart. This, to me, this is something we are always monitoring is credit spreads. It's giving us a sense of sort of risk on sentiment in the market. It's telling us that companies that have higher credit risk are able to access capital right now, and we're seeing that in the market. You're seeing sort of meme stocks and a lot of like the sort of riskier far out, maybe like the ARK funds, things like that, are getting a bid in the stock market because of the risk on environment, but also because those companies are able to access capital. There's not a ton of risk on their balance sheet right now. And so, and also investors are willing to invest in those companies and take on that extra credit risk. So to me, this looks good, and it's signaling risk on environment. With rate cuts coming, I would expect potentially for that line to actually drop even further. And then this plays into sort of what you would see in sort of volatility in the markets with the VIX and things like that. So to me, this is a signal that we're in risk on mode.
Yeah. And we're in risk on, but yet it doesn't feel risk on. Do you know what I mean? The sentiment, certainly, I don't know your take.
People are worried. No, it's a great point. I think we look at a lot of the fear and greed indexes and things like that. And, there's a lot of sort of macro doomsday commentary out there right now. I think a lot of people are looking at valuations, which are pretty high. A lot of that's being driven by the Mag 7. And so you have like 7 companies that are, really driving that. The difference here from like when valuations sort of detached, in like the tech bubble, is like these companies produce a lot of revenue, over 2 trillion of revenue last year, and expected to grow. And so I think in some ways those valuations can be, we can sort of justify them. And the rest of the market has much lower valuation when you look at the smaller in the mid caps. So I think that's driving it. Is just like the market seems overheated. Crypto's been doing really well. A lot of like the meme stocks, things like that are going off. And people are, there's also just a lot of weird stuff happening, like just in the geopolitics and politics and all of that. And I think that is adding to people's psychology right now as well. So
yeah, and I think as well, like a lot of models are broken. You know, like we are in a time of change and a time of transition as a result of multiple exponential technologies, crypto, AI, machine learning, robotics. You know, I saw a wild chart today about self-driving vehicles and how successful they've been in terms of limiting accidents. And all these things, it's a different world that nobody can predict. And I think it's leading to a lot of people saying, I don't understand this, so I'm going to sit on the sidelines, right? Because it's just like the easier thing to do. But it definitely, it is a bit of a bizarre feeling to be here and feel like, yeah, this is the time. This next quarter is going to could be a great quarter for all markets, but yet have so many people being like so bearish and so worried. It makes it very difficult. It shows the need to always have patience, right? Because you can.
For sure. And this is why we have markets, right? Like this is, there's always going to be competing views out there. And if everybody was bullish, that makes me nervous. So in some ways I get more bullish if I have a view and I have a thesis and I know lots of people disagree with it and I understand why they disagree, but I still, disagree with them. That's a setup I like, because you could have a situation where lots of people are sidelined and things just keep grinding up. And then that's how you get that reflexive move, because they have to chase the market later. So we'll see. Maybe that's the setup we're heading into here.
Okay. What's going on with GDP?
So GDP, again, just showing strength. The latest estimate from the Atlanta Fed was 3.4% for Q3. So we don't see like all of this data that we've been looking at. Like we're just looking for cracks in the economy, and we're just not really seeing it. So this looks like, earnings have been strong, margins have been strong. We see that bank lending, we look at like the banks obviously can print money as well. And so we look at bank lending, the percentage of banks that are tightening lending standards, that's been dropping throughout the year. And so we should see more bank lending. And this is just reflecting the rest of that economic data that we've been looking at. So
the best audience to distribute your product to? Your super fans, duh. But what if you haven't found them yet? That's where KGeN comes in. They help businesses scale digital distribution at a price that makes sense. KGeN's verified distribution protocol identifies the best users for your product and connects you directly to them. Ready to find real meaningful users for your next big product? Join the KGeN network today at milkroad.com/KGeN, spelled KGEN. Why do people invest in real estate? Because it spits off cash flow. But I'm not here to manage rental properties. That's why I'm looking at Figure Markets. Their new democratized prime product backs your money with real cash flowing assets and returns up to 9% APY. It's the first real world asset borrow lend pool built for everyone, not just institutions. Ready to lend like a bank and get more than the 5% Aave is offering you? Download the Figure Markets app today and get 9% on your idle funds. Go to milkroad.com/Figure Markets. Okay, before we jump into crypto and outlook for crypto, let's take a look at the stock market, because there's often a correlation there from a risk-on perspective. You got a great chart here of the S&P going back to, 1966. What do you see in here?
Yeah, this is kind of like, there's been a lot of talk about just what we were talking about earlier with sentiment and valuations being at pretty high historical levels. And this kind of pulls things into perspective a little bit here in terms of like where we're at in this bull market. So we're looking at there's been 9 bull markets since 1966. And the red line here is the current one. And, given that the sentiment is, sort of extreme in terms of valuation and things like that, in terms of the actual gains, this would be number 7 out of the 9 last bull markets in terms of percentage gains. So that is an interesting point. And then in terms of the length of the cycle, it would be number 6. So this is not a standout.
It's actually less bullish and it's not what we think it is at all.
Right.
It's so fascinating.
Right. And so there's some people, I've seen like Tom Lee out there talking about, hey, we're mid-cycle, right? We're in the 4th or 5th inning. We're not in the 7th or 8th inning. And I think, when you look at the ISM and you look at this chart here showing like historical bull markets, you can start to make a case for that. And we're just starting rate cuts right now. So I think this is an interesting way to sort of put the sentiment into perspective, I think.
Would that be your take on where we are on the cycle, that we're mid-cycle?
I think we are. I think the stock market is probably late mid-cycle. It's kind of my view. So I think there's room to run here. And the main thing that I'm looking for is just sort of how things start to play out now that we've kind of crested over this latest catalyst in terms of what the Fed's going to start to do, what they're going to start to signal to the market. I need to go back and actually watch the press conference and see what he said, because a lot of times, the market priced in the rate cuts, and what the market is going to start to look at now is like, what is the forward outlook? What is the Fed looking at in terms of inflation, in terms of the labor market, and what does the dot plot look like in terms of like future cuts? But for me, and we can get into like where we think crypto markets are going as well. But it feels to me like the people that think we're like, totally overinflated and like heading for a recession, I just don't see that in the data right now.
Mm-hmm. Yeah. I completely agree. Okay, let's go crypto. When we let's start with Bitcoin, and then we can go down to alts and the rest of the market. What are you seeing from the Bitcoin perspective?
Yeah, so this is a chart. We're looking at the point in time total supply held by long-term holders. We look at sort of cohorts of holders of Bitcoin, and we focus on Bitcoin here because if you think Altseason's coming, or I think we're sort of in Altseason, to be honest, we could talk about that. If you want to see your alts rise, if you want to see ETH outperformance, SOL outperformance, we do need to see Bitcoin continue to do well, at least sort of grind up a little bit. And what we look at here is long-term holders and the behavior of long-term holders. This is on-chain data only, so it doesn't include the ETFs. We can get to the ETFs in a minute. And what my theory is sort of that in the last cycle, the first top of the cycle, which was in April, was kind of like the actual top, even though we actually went slightly higher in November, later in the year. And the reason I say that is because that is kind of when the most new money came into the market. It was also the period when long-term holders essentially distributed their coins to that new money. And so we can see that in the orange line. If you look at the first drop there, long-term holders reduced their supply by 13.5% from like October of 20 to April of 21. And to me, that's an important thing to understand, because then as time went on, we didn't actually have like a new money come into the market. It was like very muted, and it was mostly long-term holders like getting back into the market, leverage and stuff that sort of ultimately pushed us back to the all-time highs. But there was not much behind that, and that's why we ended up going into that bear market. So now, if we sort of take that framework and we look at what's played out so far this cycle, sort of a similar dynamic where most of the long-term holders have, distributed their coins. They did that from the period of like Q1 of 24 after the ETFs came out. We ran up to about 70K or so, and we can see that the orange line is dropping. So they're distributing coins. We also saw that lots of new money came into the markets early in the cycle. So we'll look at short-term holders in a second. Short-term holders spiked up. That's sort of that moment where, okay, long-term holders are getting out, new money's coming in, that's pushing price up. And so we've seen like almost a similar reduction in terms of the long-term holder supply through January of 25, which I think you can make an argument that's like the true top in terms of like the most amount of new money that came into the market. That's when Trump launches meme coin. That's when, the Coinbase, app, Phantom, like all of the things you normally would see at like the peak of the market, where sort of all the signals were going off. And then it's sort of like, okay, what are long-term holders doing now? And we see a similar pattern here where it's like now that line is going up just like it did after the like true top of the last cycle. And the question to me now is, if we're going to have an explosive Q4 or this goes into 26, there does have to be new money that comes into the market. So maybe if we go to the next slide, we can look at the short term. So now we're looking at total supply held by short term holders, and this is sort of the reflection of what we saw with long term holders. So you can see the reason I say the first top of 21 was the true peak. Look at how we can see that the most amount of new money came into the market at that time. And then at the second peak, short-term holders the line did not spike up at all. So there was really like no new money that came in at that second peak. And so now fast forward to this cycle, similar, where you had the most new money come in earlier in the cycle at that kind of Q1 24 period, and then again in January of 25. And so looking forward, I need to see that line starting to move up. It is, creeping up a little bit. So there is a little bit of participation over the last few months. But if we want to see Bitcoin go to 160 to 200K or so, we need to see that line moving up. We need to see new money. And so that's the question, where's the new money coming from? We know that most people that wanted to get into crypto have had opportunities to do so. This has been the institutional cycle. The ETFs came out, made it much easier for institutions to participate. Who's buying Bitcoin at 120K that's going to come in and reflexively drive the price up? I think that's like the question that we're asking. We know the economic data looks good. And we're just wondering, like, what is going to be this sort of catalyst to sort of kick off a more reflexive flow? Is it going to be Michael Saylor coming out and announcing, a bunch of purchases, and there's a bunch of Bitcoin treasury companies. There's a bunch of, a long list down the risk curve as well now. But this is something that I've been thinking about. And of course, this is only the on-chain data. So we need to look at the ETF data as well. And we can look at that here. So this is just showing the spot, BTC flows, net flows for the ETFs. And so we need to combine this because we know a lot of the capital is flowing here now. And it kind of tells the same picture that you see with the on-chain data, that the most new money came in around the December, January period of the cycle. We did see another, like, a pretty good influx, 146,000 Bitcoin of net flows. That was from sort of like after we got through the tariff mess through like August or so. But if you look to the far side of that chart, like, we need to see that. We need to see some big green bars coming in there if we're going to see Bitcoin like kind of push through. I think what's the all-time high, 123 or something like that. We're going to see that shoot out to 150, 160. We need new money to come in, and so that's the question I think I'm asking. And what's that catalyst going to be? It could just be, gold's been doing really well. So maybe gold investors are doing really well and they want to sort of get a beta play on gold and they want to rotate into Bitcoin. Like, these things can certainly play out. But I think it's helpful to sort of ask the question and factor this into your thesis.
What are the two, or maybe there's more than two, but probabilities here? On one end, new money doesn't come in, and does that mean we've already seen the cycle peak? And on the other end, new money does come in, and we still have a ways to go. Is it simplified?
I think that's probably a very simple way to think of it. And, I saw Chris Berniski put out a tweet. It was like a poll the other day, just asking, I just screenshot it here. Shout out to Chris. He's basically, asking the Twitter, how allocated are you to the market? And like most, the 64% of the responses were like very well allocated. So 76 to 100% allocation. So we know, like, most crypto natives are in the market, right? Like, mostly in the market. And they're hoping that there's that retail comes in, or there's a new wave of users that come in. This is the key question. Anecdotally, I'm definitely seeing, like, people have been asking me about crypto. We're in one of those periods where, like, people are definitely, like, my friends and family and things like that are asking about it. So there could just be a new sort of awareness campaign. Michael Saylor's on TV, Tom Lee's on TV, and we sort of get that. It can certainly happen. But yeah, this is the the key question. And like institutions have been involved. So like, are institutions going to buy Bitcoin at 120K? Are they, we know that they're probably more likely to sell as well. They're not like the same like the true hodler base of these coins that we used to have with more retail participants. So I think it's a hard thing to truly quantify and add to the frameworks, but it's helpful to be thinking about like, who's the marginal buyer that's gonna be coming in. So,
and as this poll shows, it's not crypto natives; they're already fully allocated for the most part.
They're probably and this is somewhat somewhat biased because this is on crypto. This is a crypto Twitter poll, and most of these people are crypto Twitter users. So we're seeing that here reflected here, so it'll be interesting to see. I mean, my base, I don't think that we've peaked. I do think there's more juice left, but I think it's helpful to be thinking about this because it might make you change. It might impact your, just how high we potentially could go.
Okay, another great signal is how much Bitcoin is on exchanges and the shift that's happening there. What are you seeing there?
Yeah, this is kind of like just another way to look at distribution of coins. So when we see the green bars spiking up, this is net exchange net position change. So it's the amount of coins that are going into exchanges, versus leaving exchanges. When it's going into exchanges, we assume people are sending coins from, self-custody, and they're going to the exchange because they want to exit the market. They want to sell. When we see the red bars, we assume that people are buying on exchanges, sending coins to their self-custody because they want to hold, and they're buying. So when we look at the last cycle, we can see that there were like 4, pretty significant green spikes that happened. Like most of that activity happened again. This was the first peak, again, kind of signaling that was when most of the selling or new money was entering. And then we've also had 4 peaks now in this cycle. So we had one early, when the ETFs came out. We had the largest spike up was in January, during that sort of blow off phase, and we've had a few smaller ones over the summer here. What's interesting is like we're now seeing red as the last sort of like bar you see there, which looks like people are buying. So maybe that's the answer to the question we were just asking. Like it does look like there's some buying activity happening at these levels right now, and that's a good thing to see for me here, and it'll be interesting to see if that starts to flip green if we do start to break out here, and that would be an indication to me that like, okay, maybe we're heading into the final phase if we start to see that flipping green and heading higher. But yeah, just another kind of perspective on just what's happening out there with holders and how they're thinking about their investments.
What I'm hearing is that you're bullish. You still think we've got room to go, but you're looking at the charts and you're a little bit cautious and you're unsure, and maybe you've lowered I don't know if you have price predictions on Bitcoin or cycle predictions, but that's what I'm hearing is that you're cautiously optimistic. Is that correct?
I think that's fair. So when I look at the economic picture, the business cycle picture, like that gives me confidence, and like that, it's hard to say that we're like super late cycle when I look at that. When I look at the crypto data, it feels farther towards the end of the cycle to me than the economic data does. So like that is a little bit of a tricky thing to deal with, because if we are going to just see liquidity conditions, banks lending and the labor market picking up and all of these things that look like they could happen with rate cuts, that should be bullish for the crypto markets. And so, part of this is, we tend to think in these sort of like 4-year cycle frameworks, and that has been the accurate way to do this. And part of the reason for that is if everybody thinks like that, then it impacts the behavior of the markets, right? If everybody thinks we're going to peak in Q4, then there's almost a self-fulfilling, prophecy to that. So where I'm at, and this is a struggle and nobody has the answer, is just like, okay, we think we're late cycle here. We're not like, we think we're going higher. My price prediction for Bitcoin was 150K. I still think we could hit that level, but I'm like cautiously watching that to see for the signals that we're going to get there. And then, if Bitcoin continues to grind up, what I expect to happen is ETH to have another catch up. So ETH sort of had its like re-rate moment over the summer. And I think there's another phase of that coming if Bitcoin gets that bid that we're looking for, and sort of just, we want to see Bitcoin sort of grinding up, like not too aggressive, but kind of grinding up, stalling. And then like you see the wave come from ETH. ETH has been sucking liquidity from the altcoins. We're seeing some of that. Some alts have done very well over the last few weeks or so. But once ETH kind of gets through Alta, if it can get through 5K and start to push towards 6K or so, then I think we could see the big move that everyone's looking for with meme coins and kind of that longer end of the risk curve. So that would be the ideal setup. That's sort of my base case of what should happen. That would be like in line with how things typically go. But we're monitoring, we're constantly monitoring the data to potentially change our mind if we see the signals of that.
So. To me, the great reminder there is that everybody needs to be cheering for Bitcoin to go up first, as you said, grind up style. And mostly everybody needs to be cheering for ETH to go up. Even if you're not invested in ETH and you're in other altcoins, everything has to follow ETH. Like we need ETH to go up. And that is usually what, as you said, if it can get to that new all-time highs, we can get into the 6,000, then I think we can see that real altcoin season that everybody wants. But that doesn't happen if, I mean, at least it hasn't in the past, and I doubt it would again, if ETH doesn't go first.
Right. Yeah, I think that's 100% accurate. You should, even if you don't hold ETH, you should be rooting for that. And part of like the way that we try to arrive at like where we think the price could go is like a pretty fundamental understanding of like Bitcoin's sort of fair value, which we look at like the cost to mine one Bitcoin. We look at, if you look at the 200-week moving average, which is like a 4-year moving average, Bitcoin tends to bottom out when the price reaches that 200-week moving average. And then we look at realized price, which is sort of a proxy for the cost basis of the network. And all of those things look like they're going to converge around 60K or so. And so then you can say, okay, if that looks like that's going to be the bottom, then what would be if the top is 150, then you're going to get a 60% drawdown is probably, I think a lot of people think we're still not going to see these big draw. I still think we are going to get that. But we factor that into like the true like sort of fair value cost basis of the network in terms of how high we can potentially go, because we think we'll end up bottoming at those levels. And then you can say, okay, if it's a 70% drawdown, maybe you go a little bit higher or so. But I think that's the key thing. And, everything looks, there's not a lot of like arguments that can be made to be like really bearish, I think. I try to always like take the opposite view and try to see if I can understand it better than they can. And I have a hard time being like bearish at these levels, but at the same time, like, we've been in the markets for since the lows. And so if you've been in, like, you're probably not fully allocated at these levels. So when I see the Bernesky chart and lots of people are fully allocated, that's an interesting, data point for me to factor in. So
everybody's still waiting for, either they haven't had the gains because they're fully allocated to alts, or they are still waiting for the glorious bull market that we all talk about so much.
Yeah.
Michael, pleasure to get you back on the show today. Thanks so much for joining us.
Yeah, thanks for having me, Jay.
Thanks for listening in. I got to remind you, none of today's episode is financial advice. I'm not your financial advisor. Michael's not your financial advisor. This episode is for education and informational purposes only. And if you need help with your investments, you should speak to a professional. As I said at the beginning, if you're swapping, you should check out Milk Road Swap. Why? Because it's what we use to swap, because it's got low fees. Check it out at swap.milkroad.com. Thanks for tuning in. Have a wicked awesome day, everybody. We'll see you again tomorrow. We're sending Kyle Reidhead, our head of research, to the UK's largest Web3 summit. I'm talking about Zebu Live, happening October 21st and 22nd in London. Want to join? Use our code MILK to get 20% off your tickets. Hit the link in the show notes and say hi to Kyle for us. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your number one resource to help you invest successfully in crypto. One final note, this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.